Do you want to achieve financial freedom? Welcome to the exciting world of personal wealth tips. Picture a life where you have enough income to cover your living expenses without having to work full-time. That's what we call financial freedom. It's not about being rich or having an endless supply of money. It's about having the freedom to make choices, to live life on your terms. And one of the most effective tools to achieve this freedom is investing. In this video, we'll delve into 5 investment hacks that can put you on the path to financial freedom. These hacks span from strategies in the stock market to real estate tips, all designed to empower you to grow your wealth and take control of your financial future. So, are you ready to take the first step towards achieving your financial freedom? Stick around, and you might just unlock the secret to your financial freedom. First on our list is the stock market, a classic avenue for investment. Imagine the stock market as a bustling marketplace where companies offer a piece of their future profits in exchange for your financial support today. That's what buying a stock is all about. You're essentially becoming a part owner of the company, and in return, you gain the potential for significant profits if the company thrives. Now, let's talk about diversification. Imagine putting all your eggs in one basket. If the basket drops, you're out of eggs. In the stock market, if you invest all your money in one company and it doesn't perform well, you risk losing your investment. Diversification is the process of spreading your investments across different companies, sectors, or even countries, reducing the risk of losing all your money if a single investment fails. Next up is research. You wouldn't buy a car without knowing its features, right? Similarly, investing in a company without understanding its business model, past performance, and future prospects is like driving blindfolded. Research is essential to making informed investment decisions. Patience is a virtue, especially in the stock market. It's not about making quick profits, but about investing in companies that you believe will grow over time. Remember, Rome wasn't built in a day, and neither are fortunes. Lastly, don't let market fluctuations sway your decisions. The stock market is like a roller coaster full of ups and downs. But don't let the ride scare you. Stick to your plan, remain patient, and keep your eyes on the long-term goal. Remember, the stock market isn't a get-rich-quick scheme. It requires patience and strategic planning. It's about understanding the risks, doing your homework, and sailing steady even when the seas get rough. So, are you ready to dive into the world of stocks? The market is waiting. The market. Next up is real estate, a tangible asset that can provide a steady income stream. Now, let's demystify this a bit. When we talk about investing in real estate, we're referring to the purchase of property with the intention of generating income or profit. This could be through rental income, resale after appreciation, or both. So what makes real estate an attractive investment? Let's start with the benefit of rental income. When you own a property and lease it out, you're essentially running a small business. Every month, you receive rent from your tenants, and after covering your expenses, the remaining amount is your profit. This can be a robust and reliable source of income, especially if you've chosen your property location wisely. Next, let's consider property appreciation. Over time, real estate tends to increase in value or appreciate. This doesn't happen overnight, mind you, but rather over years and decades. The beauty of this appreciation is that you're not just making money from the rent you collect, but also from the increased value of your property. When you decide to sell, you could make a substantial profit if the property's value has gone up during your ownership. Last, but certainly not least, we have the tax advantages. Real estate investors can enjoy a number of tax benefits, such as the ability to deduct mortgage interest and property taxes. Plus, if you sell a property and reinvest the profits in a new one, you can defer capital gains taxes thanks to what's known as a 1031 exchange. But here's a word of caution. Real estate investing isn't for everyone. It requires a significant upfront investment, ongoing management, and a good understanding of the market. And like all investments, it carries a degree of risk. However, for those who are willing to roll up their sleeves and dive into the details, real estate can be a powerful wealth-building tool. It's a tangible, stable asset that can generate income, appreciate over time, and offer tax benefits. Real estate can be a fantastic investment, but it's essential to do your homework before diving in. Third on our list is peer-to-peer lending, a relatively new but exciting investment opportunity. Peer-to-peer lending, often abbreviated as P2P lending, is an innovative form of investment that's rapidly gaining popularity. It's a way to lend money directly to individuals or businesses through online platforms, without the need for a traditional financial institution like a bank. By cutting out the middleman, lenders can potentially earn higher returns on their investment. Here's how it works. You sign up on a P2P lending platform, deposit your funds, and then select the loans you want to invest in. These loans might be for anything from a small business startup to a personal loan for home improvements. You're essentially playing the role of a bank, lending your money directly to borrowers. But what makes P2P lending so appealing? Well, one of the main attractions is the potential for high returns. Interest rates on these platforms can range from 5% to even as high as 35%. That's significantly higher than what you'd typically get from a savings account or a government bond. However, just like any investment, P2P lending comes with its own set of risks. The most prominent risk is borrower default. If a borrower fails to repay the loan, you could potentially lose your investment. That's why it's important to diversify your investments across multiple loans. By spreading your money across a wide range of borrowers, you can mitigate the risk of any single borrower defaulting. Also, keep in mind that P2P lending platforms are not covered by the Federal Deposit Insurance Corporation, FDIC. This means that if the platform goes under, you could potentially lose your investment. So it's crucial to do your research and choose a reputable platform. In conclusion, P2P lending is an exciting investment opportunity that offers the potential for high returns. But it's not without risks. As with any investment, it's important to do your due diligence and diversify your portfolio. Peer-to-peer lending can offer excellent returns, but remember, higher potential rewards often come with higher risks. Fourth on our list are ETFs, or exchange-traded funds, a simple way to diversify your portfolio. Now, you might be wondering, what exactly are ETFs? Well, in layman's terms, an ETF is a type of investment fund and exchange-traded product, which are designed to track the performance of a specific index, sector, commodity, or asset. Unlike investing in individual stocks where you put all your eggs in one basket, ETFs are like a well-mixed salad, offering a blend of various investments. This means instead of picking individual stocks, you're investing in a broad swath of the market. Imagine having a little piece of numerous high-performing companies, all wrapped up in one neat package. That's the power of ETFs. They offer the benefits of diversification, which can help to spread out risk. Because let's face it, not all stocks perform well all the time. But it's not just about safety. ETFs are also about ease and accessibility. They can be bought and sold just like individual stocks, and they typically have lower fees than mutual funds. This makes them an attractive option for both novice and experienced investors alike. To sum it up, ETFs offer a way to invest in a diverse range of assets without having to buy each one individually. It's like getting a slice of the market pie without having to bake the whole thing yourself. ETFs can be a great way to spread your risk and still capture market returns. Last, but certainly not least, let's talk about retirement accounts. Retirement accounts like 401(k)s and individual retirement accounts, or IRAs, are powerful tools for wealth accumulation. These accounts allow you to invest money pre-tax, which means you're not paying income tax on the money you put in. Think of it like this. You're planting a seed in fertile soil, and all the growth, the leaves, the branches, the fruit, it all grows tax-free. It's only when you're ready to enjoy the fruit, or in other words, when you withdraw the money, that you pay tax. But by then, your initial seed has grown exponentially, thanks to the magic of compound interest. Now, you might be wondering about the different types of retirement accounts. Traditional 401(k)s and IRAs offer tax deductions now and tax-deferred growth, but you'll pay income tax when you withdraw. Roth 401(k)s and Roth IRAs, on the other hand, are funded with post-tax dollars, but all the growth and withdrawals are tax-free. So, Whether you're a high-flying executive or a humble freelancer, there's a retirement account that suits your needs. And the sooner you start, the more time your money has to grow. Remember, the goal isn't just to save for retirement, it's to grow your wealth in a tax-efficient way. Investing in your retirement now can lead to substantial payoffs in the future. So there you have it, 5 exciting investment hacks that can help you achieve financial freedom. Let's briefly jog our memory. We started with the stock market, highlighting the power of long-term investments and compound interest. Next, we delved into real estate, showcasing how property investment can provide a steady income stream. The third hack was peer-to-peer lending, a modern investment avenue that connects borrowers and lenders directly. We then explored ETFs, or exchange-traded funds, a diverse and flexible portfolio asset. And finally, we discussed the untapped potential of retirement accounts, a long-term investment tool offering significant tax advantages. Across all these investment methods, remember the 3 key principles: diversification, research, and patience. Diversify to spread your risk, research to make informed decisions, and have patience to let your investments grow over time. Remember, the journey to financial freedom isn't a sprint, it's a marathon. Happy investing.